Rubicon 2 Alternative Investment Fund. Will this AIF will help you create wealth, or this AIF will hurt your portfolio? Let us analyze and explore. This is Ramalingam from holisticinvestment.in. We help individual investors like you to take a right financial and investment decision. Let us first understand the basic details of this AIF. AIF is an alternative investment fund. Because it is an alternative investment fund, it is not like a mutual fund. This fund is predominantly offered to private investors through private placement. The minimum investment itself is 1 crore. So this is an exclusive product for HNI or ultra HNIs. The benchmark for this AIF is Nifty 200. So this will have 100 large caps plus 100 mid caps as well. 65% is allocated towards equity, 35% will be invested in fixed income schemes. It is an open-ended fund. Anytime you can enter, anytime you can exit. Out of the 200 stocks in the Nifty, they will identify 15 core stocks and have a concentrated portfolio for the 65% of the portfolio, because 65% they will be investing in equity. Again, the 65-35 in fixed income and equity is not fixed. They can rebalance it based on their own outlook. So their equity portion will have a core portfolio of 15 concentrated stocks. However, in addition to these 15 stocks, they can have additional 25 stocks also. So though they aim to have a concentrated portfolio of 15 stocks, they can go totally up to 40 stocks in their portfolio. Because they are identifying 15 stocks or 40 stocks from the 200 stocks, which has got a combination of large and mid, there's a possibility the portfolio may end up having more mid-cap stocks and suitable only for aggressive investors. So we need to see the underlying portfolio to decide this. The 35% or lesser fixed income allocation can be in tax-free bonds by Government of India or other fixed income securities. They'll be doing dynamic rebalancing based on the outlook, based on their requirement, based on the cash position they have got or liquidity position they need, redemption pressure they have got. They can rebalance between this from moving money from equity to fixed income to equity. They will be able to do it. This particular fund is similar to balanced mutual fund category, or which is renamed as aggressive hybrid mutual fund. So 65% in equity and 35% in fixed income. But however, taxation is much different here. We will see that later. The carry fee is 10% here. 10% carry fee in AIF or PMS is much higher. Whereas in mutual funds, SEBI has got very strict regulation on the expense ratio. What is the maximum expense they can charge in the fund? It is like detailed given in the SEBI regulation. A mutual fund cannot charge more. Whereas alternative investment funds or PMS, there is no such like a stringent regulation as far as fee is considered. So alternative investment funds or PMS can have flexibly more charges. That way, the carry fee of 10% seems to be on the much higher side for an investor. The taxation is relatively confusing and complicated. In balanced mutual funds or in hybrid mutual fund category, the taxation is very simple. If it is going to be a long-term capital gain, then obviously you will end up paying 10% basic tax. Here you will be paying tax between 10% to 30%. If you include surcharge and other cess, it works out to 12% to 42%. Different categories of income this fund will have. So to give you clarity, in balanced mutual fund or hybrid mutual fund, there are only two categories: short-term capital gain and long-term capital gain. Whereas here you will have short-term capital gain, long-term capital gain, business income and dividend income. And mutual funds are taxed only when you withdraw from mutual funds. Whereas in AIFs, it is not that way. Though you may remain invested in AIF for 10 years or 7 years, but AIF will buy and sell securities. Whenever they sell securities in your AIF, you are accountable for tax. Whereas in mutual fund, when they buy and sell securities in their portfolio, you are not accountable for tax. Only when you come out of mutual fund, you are accountable for tax. So compared to mutual fund, this AIF is not a tax efficient product because it is taxed on transaction basis, not on the overall transaction level. Then number two, taxation charges is also much higher compared to the balanced mutual fund category. To shortlist an investment, we have to apply multiple filters. We generally recommend a 3-filter approach. The first filter is to check whether this product is well regulated. Unregulated product you should avoid. Regulated product you have to invest. Among the regulated products, you can check up whichever is well regulated, you can go for it. So is this a well regulated product compared to other investments like mutual funds? Let us explore. In mutual funds, there are much stringent, strict regulations. I explained you in the expense ratio. SEBI has given very stringent rules, norms for mutual funds to charge fees. So it is one of the cost-effective way of investing in equity and money market related investments, mutual funds. Whereas AIF, it is not that way from the expense ratio perspective. And AIF is not a mass product, it is a class product. So they can have a concentrated portfolio. Whereas in the mass product, as SEBI's main aim is to protect mass investors' interest, they have given restriction on the stock level, right? For a mutual fund to have exposure in an individual stock, what is the maximum exposure they can have? They have given a restriction. Similarly, a mutual fund to have exposure in one particular sector, there are restrictions available. Because of this restriction, investors' interest is protected at a much higher level compared to this class product where the minimum investment itself is 1 crore. There is no such stringent regulations. So investor protection is not available to the extent of mutual funds where the regulation is more strict. Second filter which we generally look at it is checking the track record. Checking the track record will help us understand whether this particular investment has given consistent returns. We'll be able to analyze both qualitatively as well as quantitatively if we have a track record. And again, the track record should be there for 7 years or plus, so that we will be able to compare and contrast this with a few other investment options and we'll be able to decide. But this product has got less than a year track record, so it is not worth evaluating this particular fund at this point in time based on the current track record available. So current track record available is insufficient to check the risk adjusted return or the consistency of this particular fund's performance. It is not at all possible. So having a good track record is one thing, and not having an insufficient track record, not having a sufficient track record, right? That is a much worse thing. So in that case, this particular Trubican 2 has got insufficient track record. So we need to wait and watch for some more time to get clarity on the track record. Maybe a couple of years, let us wait and see what kind of returns this particular fund is giving, and then we can make a decision. At this point in time, it is better to avoid these kind of AIFs or PMS with less track record. Choose only simple and transparent products, whereas the AIF will have lesser transparency because it is not a mass product, it is a class product. The charges, taxation, all these things makes it as a complicated product. In wealth creation, invest in simple and boring products like PPF, mutual fund schemes, instead of investing in these kind of exclusive, exciting products. HNA investors have this appetite of thinking mutual funds or PPF or simple RD or boring products. They have already done it. Now, like, we are looking for something else which is exclusive, which is exciting. So to capture this market, product manufacturers develop AIFs and PMS, but will they outperform and give us better return than the simple and boring mutual fund schemes? 99% of the cases it is no. So it is better to avoid these kind of AIFs and PMS. In this case, Trubican has got already failed in the initial 2 filters also. So in this third filter, because of its complicated nature and less transparent nature, we are not able to give much better score here. So what is the final verdict? It depends upon you as an investor. If you are looking for exclusiveness and excitingness from an investment, then this is a product you can definitely try. If you are looking for a good return on investment, we have to wait and see. We are not able to say whether this will give you a better risk adjusted return. No. And again, taxation perspective, this has got a higher tax rate. So post-tax returns will be much lower. Complications, less regulation, all these things are working against this product at this point in time. So instead of investing in this product, you can choose to invest in normal mutual fund schemes or normal balanced fund if you are looking for 65-35 allocation. If you want to know further details about this particular investment, AIF Trubican 2, we have done an in-depth detailed research about this particular fund. It is available as a blog post in our website. Please click the link and read the article and get to know how this can create or destroy your wealth. If you have any queries on this investment option or any other investment option, feel free to register, book an appointment with our financial planner, and it is completely free. The registration link for the appointment is given below this video in the description box. Would you like to attend insightful investment webinars? We organize regular investment webinars. The upcoming webinars registration link is also given in the description box of this video. Please take advantage of this free webinar and get insights on wealth creation. If you like this video, please give a thumbs up. If you have someone in your social circle to whom this video is useful, then please share it with them. Last but not the least, please subscribe to our YouTube channel if you are not subscribed so far, so that you will not miss any of our future videos. Bye. I will see you in the next video.